You deposit 10,000 Indian rupees into your bank account. You open your banking app and see the balance, 10,000 Indian rupees. So naturally, you may think your money is sitting safely inside the bank's vault, waiting for you. But that is not exactly what happens. Your bank does not simply store your money and protect it for free. Banks are businesses, and just like every other business, they need to earn a profit. But how exactly does a bank make money from the money you deposit? Does the bank lend your money to somebody else? How much does it earn from loans? And what happens when everyone tries to withdraw their money at the same time? Let's understand how banks really make money. Imagine that you deposit 10,000 Indian rupees into your savings account. From your point of view, the bank now owes you 10,000 Indian rupees. You can withdraw it using an ATM, transfer it through UPI, or use it to make payments. But the bank does not keep every single rupee deposited by every customer inside a vault. A bank receives deposits from thousands or even millions of customers. It keeps a portion of its funds available in cash and other highly liquid forms so that customers can make withdrawals. Banks must also follow rules set by regulators and maintain required reserves and liquid assets. But the remaining funds can be used for activities that generate income. The most important of these activities is lending. A bank connects two major groups of people. The first group has extra money. These are depositors. They may keep money in savings accounts, current accounts, recurring deposits, or fixed deposits. The second group needs money. These are borrowers. They may need money to buy a house, purchase a vehicle, start a business, pay for education, or manage an emergency. The bank accepts money from depositors and provides loans to borrowers. This is where its main source of income begins. Suppose you place 1 Indian rupee lakh in a fixed deposit. Imagine that the bank pays you interest of 6% per year. At the end of the year, the bank may have to pay you approximately 6,000 Indian rupees as interest before considering taxes and other conditions. Now, suppose the bank uses its overall pool of funds to provide a loan to another customer. The borrower may be charged an interest rate of 10%. On 1 Indian rupee lakh, that would be approximately 10,000 Indian rupees in interest for 1 year. The bank pays 6,000 Indian rupees to the depositor and receives 10,000 Indian rupees from the borrower. The difference is 4,000 Indian rupees. This difference between the interest a bank earns and the interest it pays is known as the interest spread. After accounting for the bank's costs, the remaining portion contributes to its profit. However, the complete calculation is more complicated. The bank has to pay employees' salaries, office rent, technology expenses, ATM costs, security expenses, regulatory costs, and taxes. It must also prepare for borrowers who may fail to repay their loans. So the entire difference is not pure profit. Still, earning interest from loans is usually one of the biggest ways banks make money. Banks provide different types of loans, and each loan comes with a different level of risk. A home loan is usually secured by the property. If the borrower continuously fails to repay the loan, the bank may take legal steps to recover the property. A vehicle loan is secured by the vehicle. Business loans may be secured or unsecured, depending on the agreement. Credit card debt and many personal loans are usually unsecured. That means the bank may not have a house, car, or other specific asset that it can easily take if the borrower fails to pay. Because unsecured loans are riskier, banks usually charge higher interest rates on them. This is why a home loan may have a lower interest rate than a personal loan or unpaid credit card balance. Higher risk normally means higher interest. Let's take a simplified example. 3 customers deposit 1 Indian rupee lakh each. The bank now has 3 Indian rupees lakh in deposits. The bank keeps enough liquidity and required reserves to manage withdrawals and follow banking regulations. It then uses part of its available funds to provide loans. 1 customer receives a home loan. Another customer receives a business loan. The borrowers repay their loans every month with interest. The bank earns interest from these borrowers while paying interest to eligible depositors. The difference helps the bank pay its expenses and earn a profit. But remember, banks manage one large pool of money. The bank does not put your name on a 500 Indian rupees note and lend that exact note to one specific borrower. Deposits, loans, reserves, payments, and investments are managed together through the bank's balance sheet. There's another important idea that many people do not know. When a bank approves a loan, it does not always need to take physical currency from one customer's locker and hand it to the borrower. Suppose a bank approves a home loan of 5 Indian rupees lakh. The bank may credit the loan amount into an account or transfer it to the seller. This creates a new deposit in the banking system. However, this does not mean banks can create unlimited money. Banks are limited by regulations, capital requirements, liquidity needs, the availability of creditworthy borrowers, and the risk of losses. A bank that gives too many bad loans can face serious financial trouble. So lending is profitable, but it also involves risk. Interest from loans is not the only way banks make money. Banks also earn fee-based income. Depending on the bank and account type, customers may be charged for services such as ATM usage beyond permitted limits, failure to maintain a required minimum balance, checkbook services, demand drafts, international transactions, foreign currency conversion, loan processing, late payments, card replacement, and certain account management services. A small fee may not look significant when paid by one customer, but when millions of customers use banking services, these fees can become a major source of income. Credit cards are another important business for banks. When you use a credit card at shop, the bank may earn a small fee through the payment processing system. If you pay the complete credit card bill before the due date, you may avoid interest on eligible purchases. But if you carry the unpaid balance forward, the bank can charge a very high rate of interest. Banks may also earn through annual fees, late payment charges, cash withdrawal charges, and other card-related services. This is why paying only the minimum amount due can become dangerous. The remaining balance continues to attract interest and can grow quickly. A credit card can be useful when handled carefully. But for the bank, customers who regularly carry unpaid balances can generate substantial interest income. When you take a loan, the bank may charge a processing fee. There may also be documentation charges, valuation charges, legal verification expenses, or penalties, depending on the type of loan and the agreement. Some banks also earn commissions by distributing products such as insurance policies, investment products, and other financial services. The bank may not own every product it sells. It may earn a commission for connecting the customer with another financial company. This is known as non-interest income because the bank earns it without directly charging interest on a loan. You may now be wondering, if banks can earn money using deposits, why do they pay depositors interest? They pay interest because deposits are valuable to the bank. Banks compete with one another to attract customers and their money. A bank that offers attractive deposit products may receive more funds from the public. Those deposits can help support lending and other banking activities. However, accounts that provide high flexibility may pay lower interest. For example, money in a savings account can usually be withdrawn at any time. A fixed deposit normally requires you to keep the money with the bank for a chosen period. Because the bank has greater certainty about how long it can use the funds, it may offer a higher interest rate. A bank cannot safely lend every rupee it receives. Customers need to withdraw and transfer money every day. The bank must maintain enough liquidity to handle normal customer activity. It must also follow regulatory requirements and maintain sufficient capital to absorb unexpected losses. Imagine that a bank gives too many risky loans. Several borrowers stop making payments. At the same time, many customers try to withdraw their deposits. The bank could face a liquidity crisis. This is why banking is built around trust, regulation, capital, and careful risk management. When a borrower stops paying a loan, the loan may eventually become a non-performing asset. The bank may have to recognize that some of the money might not be recovered. It must set aside funds to cover possible losses. This is called provisioning. If too many borrowers fail to repay, the bank's profits can fall dramatically. In severe cases, the bank may face financial instability. This explains why banks check your income, credit score, repayment history, existing debts and job or business stability before approving a loan. Banks do not lend money simply because they want to earn interest. They lend when they believe the borrower is likely to repay. One of the biggest banking myths is that your deposit is kept separately inside a box with your name on it. In reality, when you deposit money, it becomes part of the bank's financial system. The bank records that it owes you that amount. It then manages its deposits, loans, reserves, investments, and payments as part of its overall business. Your account balance is a claim you have against the bank. This is why banking regulation and deposit protection systems are so important. Now you know how banks make money from your money. But here's a question for you. Do you think banks should pay customers more interest on their savings? Share your opinion in the comments. And for more simple videos about money, banking, saving, and investing, subscribe to Money and Me. Because understanding money is the first step towards managing it better.